Here's what's coming up on today's show.
If you don't have control of your money, then it does what it wants to. The stock market, as you have seen over the last, quarter, it's taken a faceplant.
Welcome to the How Money Works podcast with Craig and Jennifer Moser of Maestro Wealth Advisors, serving you throughout the Triad of North Carolina for more than 30 years.
We're going to talk about retiring amidst volatility this week. Now, we have Craig and Cameron here this week, so Jennifer's got the week off. But we're going to talk about the volatility that's, it's been going on since March, but it's certainly got even choppier as of late, guys. So let's get into this conversation. If you, if you don't have a strategy and a plan, Craig, I mean, it's easy to panic, right? I mean, the news tells you every 5 seconds that the sky is falling.
How does CNBC or any of those guys get paid? Advertisements.
Sure.
If you're not watching it, they don't get advertisers to advertise. So I hate to say that because it's true.
It is true.
You know, it's you make it worse than it is sometimes.
Absolutely. I mean, what's the old saying? If it bleeds, it leads, right? So
if it bleeds, where did you get that one?
That's an old news saying. That's why they always go with all the ugly stuff, you know. And it's the same thing with your money. Your money's bleeding, right? So you're hemorrhaging money. Cameron, how you doing this week, buddy? Doing all right?
I'm doing great. How about yourself?
Doing well. Thanks for being here with us. So how do we keep from panicking, guys? That's the first piece. How do you? If you have a strategy, I know that it helps. I've talked to so many people this past week saying, the headlines are saying the S&P dropped down to 13% on Monday or, whatever. And it's like, Did you lose 13%? Because you probably didn't, right? You probably only lost maybe a little bit unless your exposure is messed up.
Think about it. I mean, if you don't have a plan, you're probably a little uptight. If you just are headed for all the gusto, think about what's happened for it's been a long time. Go back to 2008. I'm taking this too far back, but they started printing money back in 2009, quantitative easing. Nobody remembers that one anymore, but was it $85 billion every month? And it went from like the beginning of 2009 until 2014 sometime. They put a lot of money in the system. And so the things that could inflate the stock market and the real estate market, brother, did it ever. It went up a lot. But truly, when you look at, what is you can't go back and change it, but you need to ask yourself a few questions. The first one is, if you are headed to or are in retirement, what you need to ask yourself is, where's the money going to come from when I quit working?
Mm-hmm.
There's Social Security, feel pretty good about that. Maybe you have a pension, one of the lucky ones. Do you have rents or royalties? Maybe you have an annuity that has a guaranteed income stream. There are things that, you can count on for income, but you haven't really done a measurement. You're just saying, this is what I have.
Right.
This is what's coming in. So just ask yourself some real questions. First thing that we do as financial planners is we ask, what is your goal for income? Because if you don't have a goal, there's nothing you can shoot toward. We have great software. We put this stuff together. But if you say, I don't know what I want, I can't measure against it. So let's pretend something. I want $100,000 a year net after taxes. I want you to make this thing go up with inflation, Cameron. So every single year, I want to, like next year, if you have this year, it's $100,000. Next year, it'd be $103,000 that you need, so on and so forth. Now you have something to shoot toward. You can say, here's what's coming in, and then your pile of money, that stuff that you've saved and never ever thought about using, now that has to give you the difference, the gap, what you have coming in. So that's an important thing to think about. Once you've ran those numbers, there's really two sets of numbers. How much do you have to have? It's sort of, I can get by on, I hear that line a lot. It's like, I can get by on this. And I'm like, well, is that all you want? Is just to barely get by? Or do you want to have all of your expenses, your essential stuff? And then the other side of it is, do you want to have some lifestyle? Mm-hmm. So for me, I have 3 grandkids. I love them. I like to get them stuff. And so I want to have that money. Is there a bucket list for travel? With my wife, there is. For me, kind of. I like to travel, but she loves to travel. So those are all things that, as you're saying, here's my goal, run those numbers. And so we put it through a lot of different, sieves, scenarios. We don't just run one set of numbers. So once you get all this compiled, now all of a sudden you're saying, can I succeed this and how well can I do? The other side, Cameron, I know he's over here twitching, wanting to talk about risk.
We'll let him get in here. Come on.
So is how volatile is the investment portfolio that you have?
Yeah, exactly. So from the risk exposure side, it's important to know where you stand. Knowledge is power, as they say. So how would you respond to risk when it comes knocking at the door? How risky is your current portfolio? Oftentimes, people stop in to see us for the very first time, and they don't know the answers to this question. And that's the very first thing that we take them through. We take them through some questionnaires that analyze their risk aptitude and appetite, and then it determines what kind of a portfolio would be best suited for them. And then we kind of set that as the standard moving forward of, hey, this is what you have been comfortable with in the past. Are you still comfortable with it as we grow that relationship?
And then the other side of that is actually, where are you in the grand scheme of things? Because for one thing, if you're just early on, so I'm looking at a guy that's 31 years old. He's got a big appetite for risk. When things go up, he wants all of it and then some. And he's willing to live with some of the downside. I'm older than he is. I'm not. I don't like money loss. So when you're thinking about how do I build a portfolio that's resilient, that doesn't take in too much loss, that's a certain group of people. Usually if you're over 55, you've done a bunch of savings. You have a pile of money, and you're not too interested in losing 20 or 30% of it. Let me give you some things. The S&P 500 was 1,500, 1,600 around this time, 2013. I don't know why I picked that year. I just did, about 12 years ago, and now it's around 5,000. What is that, 3.3 times on growth in that 12-year window of time? So that's a lot. If you're moving into this red zone for retirement, think about how expensive stocks are and ask yourself, am I ready to retire, and what am I going to do? So let me give you a real example. Let's say you have $1 million in your retirement account. It's invested 100% in the S&P 500. So to me, that's aggressive.
100%, yeah.
You're taking $50,000 a year out of that account, and you want to adjust up for inflation every year. Well, in recent past, 2022, the S&P was down by year-end 18%. It was down 27 right in the middle, October, but by the end of the year, it moved up some, down 18%. So if you had $1 million and you took $50,000 out, and then you lost 18%, that's $180,000. The following year, you're starting off at $770,000. And if you inflate your goal, $51,500 now, all of a sudden you're way behind. That's called sequence of return risk. You don't know what's going to happen unless you have the big C. What's the big C, Cameron?
Control.
If you don't have control of your money, then it does what it wants to. The stock market, as you have seen over the last, quarter, it's taken a faceplant. Why? Tariffs. A lot of things have changed. And if you're not in a position to where you have control over certain parts of your portfolio, well, you could lose a lot. And if you're pulling your income out of that, it can be devastating. So you've got to be careful. The S&P, as an example, is a great investment index. It's done really well. It's beat most everything else over the last 5 or 10 years. But it's not a great tool for distributions. So you have to use a different strategy to take withdrawals or distributions versus what you're saving and investing for the future on. It's a different approach. It's hard to get your head around it. Cameron, talk to us a little bit about, for example, if you lost, say, 20% in the investment portfolio, do you just have to make 20 to get back?
No. So if you were going to lose 20, you'd have to get back 25 to be back to even. That same situation, so you lost 10%, you've got to get 11% back to be even. And I'll go even further. If you're going to lose 30%, you have to get a gain of 43% to be back to even.
So how often can you do that? I mean, how long would it take you to get a 43% return?
It would be a little bit more comfortable for someone in my situation who's 31 versus you who's more than 31.
And nice, well played. This whole situation in the past couple of weeks is kind of like a love letter to diversification, because you got the media and the news telling you that the market's down, what it's down, and so on and so forth, and people think, oh, that's what I'm down, but often they don't know what they have or why they have it. And to that point, whoever wants to kind of take this, but I was just talking with somebody earlier today, and they had been getting a call from one of their clients saying that she was really upset, worrying about how much she had lost because she's been watching the news. Well, when they talked to her about her plan, she was in mostly structured different kinds of income payments and things, had very little in the market. So she really wasn't down very much at all. And it's a great example of how you can get so worked up about what you're seeing on the news and it doesn't really relate to you. Or if it does, do you even know what your plan is, right? What your strategy is? Are you diversified enough that you're not feeling this pinch as badly as you might think you are?
So it's very important to be diversified going into a situation like this. I mean, just looking back in the past 20 years, if you look at the asset classes that have performed the best, it changes every single year.
Right.
You don't know if it's going to be U.S. stocks one year or REITs or emerging markets. So it's important to know, what you're in and then how those specific asset classes are performing in comparison to just looking at the broader S&P 500 or Dow or whatnot.
Right.
It's been pretty easy just to use the S&P. Who are we kidding? It's been great the last 3 or 4 years other than 2022.
Right.
But when we are working with somebody, especially if you're moving into the retirement years, you're saying, okay, in the next 5 years, 10 years or so, I'm actually going to need my money to pay me instead of me paying it, then a thought might be this. We use a strategy. I've used different ways to try to explain it, but let's just say the buckets because that's really what it is. You have let's say you have 3 buckets of money. Bucket number 1 is that money you're going to use right now. It's not subject to market volatility because you're using short-term treasury bills, you're using money market, and that's money you're going to spend over the next 1 to 2 years. So why put it at risk? Put it in something that's going to be there and you pull it out and it earns a little bit. The bigger bucket will probably be bucket number 2. Think about this. I put money into things like corporate bonds. If you're in an IRA, we use structured income notes that pay high yields. We put things into high dividend paying stocks, and we're looking for where's my check? Cash flow. We're not really, yes, we are interested in something going up, but we're not expecting stock market returns. We're expecting high, strong income. And we're taking that income and we're either plowing it back in bucket number 1 or we're reinvesting it depending on how we're set up. And then bucket number 3 is what most people do all the time. They put that money into stocks, into investment grade real estate, and they're looking for appreciation, maybe a little bit of income, but really appreciation is really number 3, and that one has more volatility. That's the one you're hearing on TV. That's the one that when it's going up, they get on and pound the table, and when it's going down, they say you should have been out last week, right? Of course. So the whole idea is the build. How do I build my portfolio so it's resilient, it has cash flow, and it's also not so darn conservative that it's just stuck all into fixed income and CDs and T-bills and things like that. You have to have a build out that approaches your timeline and how you're going to be able to use your money. It's different than when Cameron over here is adding to his portfolio. He's excited. Everything's on sale.
Yeah,
and
right.
So he's like, heck, what do I buy, And for me, I'm like, I'm glad I was out about 3 or 4 weeks ago. I'm not really trying to hit home runs here. I want to keep my money and my cash flow. So it depends on where you are in this thing, in this timeline. But the reality of it is he hit it on the head. Don't put everything in one place. Don't have all of it in an annuity. I think that's an absolute screw up. Sorry. And don't have everything in the S&P 500 either, because they're tools, and different tools satisfy different parts of a job.
Well, let me ask you this then, and Cameron, if you want to kind of start this, and then we'll let Craig jump back in. But thinking long term, right? So, yeah, but even if you're 60, right? I mean, ideally, hopefully, you're going to be retired for 30 years, right? So you still don't want to be wholesale jumping out when there's volatility, right? You still want to be thinking long term. You still have to have something, out there in the investment world, correct?
Yes. So you want to go back to the 3 buckets like Craig was saying. So you want to have a growth bucket. That's your long-term need. You want to see it go up, obviously. You don't want to have a love letter that you're single on Valentine's Day. But
Right. Good.
But you want to focus that growth bucket on the ones that are a little bit riskier or more aggressive types of investments. On the other side, the income bucket, obviously you want it to pay regular income so you can afford to live life. And then you've got your safe bucket that if you, didn't have the income, for example, for some odd reason, you've got 3 to 6 months of money back stored away that you can afford to live life once again. Or if you need to replace a roof.
Yeah. Yeah, and I think people get so, Craig, they get so easily manipulated by the news media because it's constant bombardment, right? And it is sometimes harder to think longer term because if you're 60, 62 years old, you're thinking, oh man, this is going down, this isn't good. But what is it actually affecting you? I think a lot of people don't know.
Yeah.
Assess what's actually affecting you at the moment and not what you just speculate.
Let me give it to you. Let's talk about a build we would have.
Okay.
We just had a couple that retired, so we put 18 months back in money markets and T-bills. Why? Because they're going to spend that money.
Okay.
That money doesn't care what the stock market's doing at all. It's just going to pay interest and give them all their money back, and we're spending it. We have a block of money. It's about $600,000, and it's sitting in bonds and structured income notes, and it's just spitting out about 7.5%, just income. And we'll take that income and plow it back into other things, but what we're really going to do is have that bond ladder that we're using that income for, those notes, and when they mature, we'll take that money and put it into door number 1 and spend it. We're not trying to use that as a long-term investment. We're using it for cash flow. And so we have a cash flow machine in the middle, and we have money in smart indexes. So a smart index says, yes, I'm all in if the market's going up, if we're in a uptrend. But it also says, if you break my trend line, meaning the uptrend now is a downtrend, when those equities go down, it's not just going to sit there and go, oh, okay, well, I went down. That's just not how we set it up. And in there in between, in number 2, we also usually put a fixed indexed annuity. We want that annuity to have a rider that guarantees a payment, but we want that to cook for a while. We want to build that income guarantee up a lot so that when we get ready to turn the cash flow on, it's substantial and it will replace the income gap. We can be very intentional on that. So door number 1, door number 2, and number 3 is where you put your growth ideas, where you have things that are longer term. So what's out there in the future? Let's be real. Artificial intelligence is there. It's just kind of volatile. The other side of it is you don't have to use just the stuff where you can push a button to buy and sell. I kind of hate that. It's not as good as it used to be. Back when I started, there was like 8,000 different companies that were publicly traded that we could buy on the markets. Well, there's like 4,300 now. So you think about all of these people chasing 4,300 different companies in the stock market. It's almost like Las Vegas a little bit to me. And so, somebody says something bad on the television and the market goes down 1,200 points. And you're like, really? So McDonald's is not going to sell any hamburgers tomorrow, or Duke Energy's lights are going to cut off today.
Yeah.
It's kind of ridiculous. America invests per quarter. If you don't have a good quarter, you get bludgeoned to death. And you look at, honestly, China, they got a 100-year plan. They're not interested in what happened this quarter because every quarter stuff changes. So, when you're investing, you need to look forward and say, where does my money really need to be 3, 4, 5, or 6 years from now, and not hope that it just is, goes up and you can hit the button and sell. I mean, that's fun. I got it, but go to Las Vegas and have some fun. But for investing, invest and own some things that have long-term prospects for positive outcomes. That's truly thinking in the long-term perspective for that part of your money.
Thank you so much for checking out the podcast today. If you have any questions about what we've discussed, remember, you can get a complimentary financial review with the team at Maestro Wealth Advisors by calling 336-448-1086 or go online to howmoneyworksradio.com for other great resources and ways to reach the team. You can also check the show notes of today's episode for our contact information as well. And don't forget to subscribe to the podcast on your favorite app so you never miss an episode. We're on Apple Podcasts, Spotify, Google Podcasts, and all the most popular apps. For Craig and Jennifer Moser, I'm Mark Killian. We'll talk to you next time on the How Money Works podcast.
Craig Moser is a financial advisor and certified financial planner. Securities offered through Avantax Investment Services, member FINRA SIPC. Investment advisory services offered through Avantax Advisory Services. Insurance services offered through Avantax Affiliated Insurance Agency.